Hey everybody, welcome to this week's Vision Possible teaching. My name is Ryan Haley, and this week I want to talk about inflation, interest rates, saving, and debt. Now that's a lot to talk about, so this is going to be probably a little bit longer than my typical videos, but I think these are some things that are really helpful to understand and learn how to utilize them to your advantage. Now, I should first caveat everything by saying that I am not a securities licensed investment advisor. I'm not yet officially a certified financial planner, though I am working on that designation right now. And everything that I'm sharing is just a very broad, high level overview to illustrate the concepts. So nothing I'm sharing is specific advice for any specific individual, but I want to just frame this conversation and illustrate some concepts using my own personal experience and some basic economic principles to help people to understand how they can position themselves in this current financial and economic environment. And I should also add that this is a fairly complex look at some things. So I've talked about some of these things before. If you haven't already, I would encourage you to go back and look at some of my past videos where I talk about some of these things. But this video, if it's all you watch, should give you at least enough to be able to have the information. You may have to watch it several times to really understand it. But at the end of the day, the reason I share this, as I always mention, is I want to help people to financially position themselves so that they can achieve their vision and their purpose, so that you can turn your daydream into a day job, as we like to say at Vision Possible. So that's ultimately the reason I'm sharing all these very detailed things. And I hope that it positions you to be able to have the freedom to step into your vision and to make that potentially a full-time opportunity for you. But at the very least, I think these concepts I'm going to share in some examples will help you to understand how money works and how to position yourself in this environment. Now, some of the biggest things that I want to talk about today are the combination of inflation and interest rates. Now, most of us have been in the last decade or more in a near zero interest rate environment. So what that means is if you're keeping cash in checking or savings accounts, you're earning virtually 0%, virtually no return on keeping the money there. I remember, back in maybe 2005 when I was earning, I think it was like 5% in just a regular savings account. Those days are over and have been over for a long time. And it looks like we're not going to be, anywhere close to that for the foreseeable future. So the Fed, which is the Federal Reserve, has indicated recently that they plan to keep interest rates near 0% for at least the next year or two through 2023, as they evaluate how the economy is recovering from COVID and, kind of see where things stabilize. Now, most of what we've seen in the last year has been a huge amount of inflation, and that to some degree is expected, because the economy came to a complete standstill for 12 months or so, and it takes a while to get the supply chain back in effect. A lot of you guys, probably like me, have noticed it's really hard to find things online, that things are usually out of stock. A lot of companies are scrambling to get their inventory in line with customer demand, and as a result, we've seen prices increase. Now, part of that is just because of a fundamental supply-demand imbalance. We have more demand than we have supply for a given amount of goods, and therefore it makes sense that prices would increase. We also, on top of that, have inflation, generally speaking, which is not only driven by supply and demand, but is also driven by the huge amount of money and debt that the government has injected into the system. So they've printed trillions of dollars of money in the last 12 or so months, and look to continue to do so. And that has the effect of devaluing the existing currency. So inflation is very real right now. This year, it's around 5 or 6%, and it may, taper off in the future as things kind of stabilize, but we don't really know. What we do know right now is that if you're keeping money in a checking or savings account, you're earning virtually 0%. And we also know that right now, the inflation, generally speaking, across the board is around 5 or 6%. Now, that's important to know because a lot of people feel very safe and secure having cash in a checking or savings account. because it's not going to lose money, at least in what we call nominal terms, which I'll explain in a second. And you're not taking any risk to keep that money there, like you would be as far as taking that money and investing it in the stock market or real estate or other types of riskier asset classes. So there is safety in holding cash in checkings or savings accounts. But what a lot of people don't think about is not the risk, but the absolute certainty that as inflation increases and you're not earning any return on your money, you are going to lose money in what's called real terms, just by the fact that inflation is increasing, but you're not earning that same interest rate on your money. So when I talk about nominal versus real, nominal is not inflation adjusted. Real means inflation adjusted. These are economic terms. So if you have $100 in a checking account, your nominal amount of money is $100. Next year in 12 months, you still have a $100 nominal balance in your checking account. But in real terms, i.e. inflation adjusted, if inflation is 5% over that 12 months, even though you have $100 nominal in your checking account, you have purchasing power of only about 95% of that, because inflation went up. So the value of a dollar today will be worth about $1.05 in 12 months if inflation's 5%. So even though you haven't, quote unquote, lost money that you can visually see if you look at the checking account balance in your bank, you are losing purchasing power. And that's, I think, a really important concept that not a lot of people really think about. And that is one of the oldest, most classic ways that governments impose a hidden tax on their citizens. As we keep inflating the money supply and prices increase through inflation, people have less purchasing power with a given amount of money. And this is a very real dynamic right now with the way that the government's printing money and injecting all this money into the system. Now, obviously, it's helped a lot of people. And I think that there was, some very real concerns and benefits to the government having done that. But if it keeps this pace up, then we are going to probably see inflation very high over time, whether or not you see that officially published in the government data. And government data, I always take with a grain of salt, because they say that the average inflation rate over the last, 10 years or whatever it's been since the end of the global financial recession is around 2%. But if you talk to the average working person, you're probably seeing a heck of a lot more than 2% in a lot of things like rent, food, gas, groceries, that kind of stuff. So I tend to think that the officially published numbers by the government for inflation are lower than they probably are in reality in a lot of cases. But just to make a point, let's say for the sake of argument, those numbers are true. I want to give you an example of the power of inflation from my personal experience having bought a property in San Diego in 2006. Now, I was 26 years old at the time. I didn't know any better, but everybody said buying real estate was the quickest way to build your net worth and build wealth over time. And generally speaking, that's true. However, unfortunately for me and most people, we had no idea that in 2 years from that point, we were going to see one of the greatest real estate meltdowns and financial crises we'd ever experienced. So the old, kind of thought process of you just buy real estate and it's always going to go up and up forever, unfortunately, was not the case. So it blows my mind to even say this, but in March of 2006, I bought a 1-bedroom, 1-bathroom, 728 square foot condo for $317,000. And that was considered a deal at the time. Now, that was $317,000 in 2006 money. That is worth a lot more today. So if you look at the Bureau of Labor Statistics at bls.gov, they have their officially published inflation rates. And when I looked this up, $317,000 in 2006 is now worth about $433,000 because of inflation. And that is relatively low inflation over that 15-year time period. So just to keep pace with inflation in real terms, that property would now have to be worth at least $433,000 just to break even. Unfortunately, that property is only worth about $379,000. So just from inflation alone, I have lost purchasing power or wealth in real terms over that 15 years. So if you look at, the nominal dollars, again, nominal being not inflation adjusted, if I bought the property for $317,000 in 2006, and today it's worth $379,000, then on nominal terms, I've made a little under a 20% total return. However, if you look at that on a compound annual basis, that's only a 1.2% compound annual return over that 15 years. Now, most people would not look at 1.2% as a very good number to get in an investment, but it's especially bad when you look at the inflation rate being about 1.9% over that time period. And the difference of the $379,000 in nominal terms versus $433,000 inflation adjusted means that not only did I not make about a 20% return, I actually lost wealth over that period of time just because of inflation. So that's pretty important to realize. And I, again, was doing what I thought, was the smart thing that everybody thought was the smart thing at the time, which is to buy real estate, get in the game as a young man and start building my wealth. And again, over the very long term, that is true. But you have to have a very long-term mindset when you're looking at things. To make matters worse, unfortunately, I was not able to hold on to that property, and I sold it 6 years after I bought it for about a 50% loss. So this is a really important concept that I want to make sure you guys understand, because I didn't understand this at the time, and now I see how critical it is, and that is cash flow. Cash flow is so important because even over that period of time where my property went down in value by 50% and we had all this kind of craziness in the markets, if I could have held on to that property with its $2,400 per month mortgage payments, then it wouldn't have really mattered, because again, over the very long term, talking 15, 20, 30 plus years, I knew that property was going to increase in value. And on average, over the very long term, property prices tend to generally appreciate more than the rate of inflation. Again, that was not the case for me, but especially not for me because I had to sell it at a 50% loss. Now, why did I choose to sell at a 50% loss? Well, it was a very agonizing decision for me, but again, it comes back to cash flow. That $2,400 a month mortgage payment was not sustainable for me as I was considering getting out of the Navy and not having that nice, stable paycheck. I was entering into the world of entrepreneurship, and I knew that my income was going to significantly decrease, and there was no way that I was going to be able to make that $2,400 a month payment. So unfortunately, in 2012, I sold it for $165,000. And luckily for me, the government had a program for military people affected by the housing crisis where they paid off the remaining loan balance. But it was still, for me, a pretty bitter pill to swallow, having made $2,400 payments every month for 6 years with nothing to show for it. By the way, not only that, but when I had to move because I got orders to another area, I rented out that condo and I was only making about $1,200 a month in rent. Plus there was expenses. So at best, I had $1,200 a month of negative cash flow. Now that was pretty horrendous. Luckily, I was making decent money in the Navy with that stable guaranteed paycheck. So I was able to get through it, but it got pretty tight for a while. If I didn't have that stable paycheck, for like right now, as an entrepreneur who's generating my own income that fluctuates a lot, then it could have very well meant me having to foreclose on the property and declare bankruptcy, or have the bank take the ownership of the property, which is not a good thing under any circumstances. So that is a really important thing that I want to talk about in light of some of the things I'm going to say in a little bit here, is that when you are making an asset purchase that is intended to increase your wealth, if you're using debt like I did, I was using 100% debt, then you really need to look at the cash flow, because there's so much uncertainty in the economy and the financial markets right now. But the one thing you can count on for sure is, come hell or high water, every single month, that mortgage payment or whatever that loan payment is going to be due, and you need to pay that in full in order to avoid a bad situation. So I had a lot of things that I didn't know at the time that I would have done completely differently now. But I've learned from those mistakes. And recently, as you guys probably know from watching these videos, I bought and sold a property. I bought it in 2017, sold it last year in 2020. because I had implemented those learning lessons from doing it wrong the first time, I made a great return and it worked out great. But it took a massive failure earlier in my life to be able to get that kind of perspective. And so I want to hopefully save you guys from making those kinds of mistakes, or at least give you some insight as you're making some decisions. Now, when it comes to inflation and interest rates, again, being in a high inflation, zero interest rate environment is a very punishing environment for savers, which is typically me. If you're holding cash and checking your savings accounts, you're not willing to take the risk to get into the stock market or real estate or any number of things, which I include myself in this, then yes, you're avoiding potentially a bad investment decision like I had with that San Diego property, but you're also missing out on the potential returns you could be getting, and that's called opportunity cost. So opportunity cost is the difference between what you could have been making versus what you currently are making. So if you're having cash sitting and checking your savings, you're making virtually 0%, versus if you made an investment that had a 10% return, then your opportunity cost is 10%, the difference between what you could have made and what you are making. Now, it is important to say that you don't want to take unnecessary risk to get those kinds of investment returns. So you need to really understand the fundamentals of the asset that you're buying. And again, for me, in 2006, I didn't understand the value or the necessity of cash flow. I didn't understand market cycles. I didn't understand responsible use of debt, and I suffered for it. But again, I've been able to use those lessons, even as painful as they were, to help me more recently. So you kind of feel like you might be stuck in a between a rock and a hard place here, right? So you don't want to invest in risky assets and lose money like I did, but you don't want to keep your money in checkings or savings accounts. So what can you do in this environment of high inflation and low interest rates? Well, having said all those things that I very intentionally mentioned, if, and this is a big if, you are able to buy a productive asset that is going to increase your wealth over time, that has a reasonable risk return profile, then this is an era where using low interest fixed rate debt over the long term can potentially help you, because interest rates are probably the lowest we've ever seen and that we will ever see. And it sounds like that's going to be the case for quite a while. Meanwhile, inflation is continuing to erode the purchasing power of your dollar. So again, I only even mention this in the context of, number one, only using debt to purchase productive assets. That is, assets that are going to increase your wealth more than the cost of the debt that you're using to acquire them. That's super important. Most important, like I said before, is making sure that no matter what, you can afford those monthly payments for as long as you have that debt. I've talked to a lot of people who are thinking about investing in real estate or have recently purchased homes. They're asking me different things, and sometimes they have these really great scenarios like, yeah, I think it's really undervalued. I can add, an extra bedroom. I can rent it out. I can increase rents. Prices are going to appreciate over time, and I could do this and that. And I say, yep, that's great. Those are some really great, points to consider. But I said, again, all of that is uncertain. You don't know how much you can get for rent. Even if you know that right now, that may not be the case in the future, as I found out in 2008. Also, you don't know what is going to happen to the appreciation or the price of your property. You pretty much don't know anything except for, once again, come hell or high water, every month that mortgage payment's going to be due. So make sure that in a worst case scenario, you can afford those loan payments. Now, if you looked at that, and done the due diligence of looking into the risks and the benefits of the asset, and you're very confident that you could continue to pay those debt payments, then I think this is an environment where, with interest rates being super low, which actually helps you as a borrower, even though it punishes you as a saver, and with inflation being high, then locking in probably some of, if not the lowest interest rates we've seen in history, could be a very good thing for you, because inflation works both ways. It can erode the purchasing power of your assets, i.e. your cash, but it also erodes the value of your debt, because you're locking in a fixed payment at a certain amount. So let's say you're buying a home and your mortgage payment, let's say you're getting a 3% 30-year fixed rate loan. If your mortgage payment is just say $2,000 a month, that $2,000 a month is not going up with inflation over time. That is a fixed amount. So if the inflation keeps rising at anywhere close to the level that it has, but even if it's very gradual over time, after 30 years, that $2,000 a month payment in this example is worth a heck of a lot less than it was in 2021 when you got the loan, or whatever year it was. So if you can use that debt productively to buy an asset that's going to benefit from inflation as well as low interest rates, you're sure that you can make the payments, and you are not speculating as to the value of your property going up to bail you out from a bad decision, and you've looked into it really well, then this could, for some people, be a great strategy. And leverage, like inflation, can work for you or against you. With leverage, you are using other people's money, whether that's a bank or investment capital that you raise for people, or whatever the case is. If you're only using a fraction of your own money, like in purchasing a home where you have a down payment that you pay and then the bank covers the rest, then your returns are magnified, because if the property appreciates, let's say 10%, and you paid, $10,000 for a down payment, then that is you've doubled your money, because you didn't pay the full, and let's just say it's $100,000 for the investment. So if the home's worth $100,000, which I know this is not a realistic example for most people, where homes are worth a lot more than that, but let's just use round numbers. If you buy a property for $100,000, it appreciates by 10% over some given time frame. Then if you only use $10,000 of your money, then you've doubled your return, even though the asset level increase was only 10%. But as I found out the hard way, leverage can work against you as well. If I put in, $10,000 for my down payment, and my property decreases by 50%, like it did in 2008, then now I haven't just lost $50,000. I have actually lost, basically I've lost 500%, right? Because I paid 20,000 or 10,000, and the value went down by 50,000. So my loss is magnified by 5 times. So again, with inflation, with interest rates, with leverage, you can either profit from it or you can be hurt by it. And I hope that you can understand things well enough to know what kind of things are going to be a reasonable risk-adjusted return, how you can use leverage and debt to actually work for you instead of against you in this type of environment, how inflation can actually work for you instead of against you. But again, it all comes down to really understanding the investment, understanding the dynamics of the economy, and you may have to use some realistic but uncertain assumptions about where things are going in the future. Now, one thing I will say that gives me some degree of confidence is that we know the federal government is running the biggest deficits. It has the biggest debt it's ever had in our history, and it looks like it's going to continue doing that for a long time. So it is very important for our government to keep rates as low as possible, and it actually benefits from inflation, because they're in the same boat that I just described that you could be in. They're borrowing more than they've ever borrowed. So low interest rates obviously help them. But if inflation is going up, then inflation erodes the value of the government's debt. So I think it's fair to say that the US government and the Federal Reserve has a vested interest in keeping rates as low as possible and inflation as high as possible within reasonable limits, because they are going to get very hurt by even a 0.25% rate increase. So that's not officially their job, is to manage their debt level. Their official job for the Federal Reserve is to try to get employment to as full as possible, and to maintain what they call price stability. Obviously, we've seen a lot of price instability over the last 12 to 18 months because of the pandemic and the whole economic crisis. But I think there may be an ulterior motive to the government wanting to keep rates low, even as inflation's going up, and it's because they benefit from it. So if knowing what the largest market participant in the world is going to be doing and how things hurt or help them, that could give some indications as to aligning yourself to profit from the same kinds of environments that the government's going to profit from. In this case, that environment being a low, if not zero rate environment and higher inflation. So, sometimes you might hear the saying, don't fight the Fed. I have been fighting the Fed, waiting for good investment opportunities, waiting for the stock market to crash, waiting for real estate markets to crash, and haven't been able to see anything that has really, if anything, it's been the complete opposite. So I continue to be punished by holding on to cash and savings and checkings accounts. But as I get more sophisticated, I'm trying to figure out how to make reasonable investment decisions that don't take too much risk, but that also don't incur the certainty of a loss of purchasing power through inflation. So one thing that I've been reading in a lot of economic and investing articles is the value of having a portfolio that will allow you to participate, but also protects you. So when I say participate, but protect, I mean, you don't want to be sitting on the sidelines while asset prices and inflation are going up and you're still getting 0% on your money, but you also don't want to be caught in a negative downturn because who knows what's going to happen with this economy, by all reasonable valuations, the stock market is completely out of whack with fundamental reality in some levels, although you could look at it and say, well, given the extreme nature of what's happening in the economy and the financial markets, maybe that's not quite as unreasonable as it appears. So I don't know what's going to happen in the future. Nobody really knows. The Fed has even come out and said they don't know, which is, nice honesty from them because that is absolutely true. No one person can know what's going to happen with any degree of certainty in the markets. But if you can have a portfolio or an investment that is hedged against downside protection, with downside protection, against downside risk, but also can have some upside potential to at least keep pace with inflation, if not exceed it, then that's a pretty good place to be. Now, how can you, invest in these kinds of things that have these characteristics? Well, there's any number of ways you could do it. But one thing that I'm looking at right now for myself, as well as a lot of clients that I'm talking to, is something called an indexed universal life policy, or what's abbreviated as IUL. And an indexed universal life policy allows you to get some market upside in the stock market or some kind of index like the S&P 500 or the Russell 2000, any number of different things. But it's constructed in such a way that you also have a 0% floor, meaning that if the stock market crashes and goes down by 50%, like we've seen in the past, then the worst you can do is 0. In exchange for that, the highest you can get is capped at a certain level. Right now, in a particular product I'm looking at, it's 10%. So I'm okay with that. That's a pretty reasonable risk reward profile. I can get as high as a 10% gain. And even though if the stock market goes, above a 10% gain, then I'm not going to get anything beyond that 10%. I'm okay with that in exchange for a 0% floor. So that is a great example of an investment, even though technically life insurance is not an investment, and I have to make that very clear, but it is an asset class. It's a financial vehicle that allows you that upside potential with that downside risk. The other thing I really like about it is it's extremely tax efficient when it's structured properly. So that is just one example that doesn't take a whole lot of, you don't have to be some super smart, hedge fund trader or options trader, putting these really complex trades into motion. You do need to understand it. It is a more complex product than just like a typical whole life insurance policy, certainly more complex than a term policy that has no cash value, but it gives you, upside potential, downside protection, extreme tax efficiency. And it also allows you to have your money working in two places at once so that you could borrow against the cash value in your insurance policy and use that to fund another investment that gets an even higher return. So again, that does incur some level of debt, even though you're borrowing against your own cash value. You are going to be paying interest on that, but you have much more flexible terms that you can choose if, when, and how much to repay the principal on the loan. So again, using that combination of smart leverage, understanding the risk benefit ratio of the investment, understanding how to participate but protect in your portfolio, and also understanding the different relationships between inflation, interest rates, opportunity cost, and the erosion of your purchasing power that would happen if you keep money in cash, checking, or savings. So that's only one example, and there are probably multiple others. If you can find something that you feel comfortable with, you know that you can afford the payments, real estate can still be a great asset class to invest in. Obviously, with real estate and stocks, where prices are extremely high right now, so there's some risk that things could correct very quickly and not for the better. But there's also the chance that things keep going as they have for a long time. This market seems to defy all odds or expectations in the way it keeps going up. At some point, there will be a correction. But again, if you've got that downside protection, then that can be a real asset to you. So I hope this has been helpful for you guys. I know we covered a lot of material. One thing that I will say is that if you're not sure about the investment and you're saying, Ryan, you raise a good point. I don't want my money losing, purchasing power to inflation by keeping it in what I consider a safe place, like a checking or savings account. I would say this, and this is what I have personally done. I would rather have my money sitting in cash in a checking or savings account, even though I know full well I'm losing to inflation every year by doing that. I'd rather do that than make a bad investment decision that loses me money. Again, I learned the hard way when buying that property in 2006 and having a huge loss when I had to sell it. So, Warren Buffett, who's arguably the greatest investor of all time, has said that when it comes to investing, the number one rule is don't lose your money. Rule number two is refer to rule number one. So he is very, very good and focused on looking at the downside risk. The first thing is, I'm not looking at the upside return. I got to make sure that this is a safe investment that I'm not going to lose my money in. And then after that, I can look at, the return profile. And of course, there's no guarantee in any investment. There's uncertainty by the very nature of it. But when you have those kind of built-in safeguards, then it adds a lot of risk mitigation to the strategy while still helping you not to have to, lose money every year by just having inflation erode your purchasing power. So again, a lot of things that we talked about today. I encourage you to rewatch this video, go back and watch some of my other ones. You can also reach out to me if you're interested in talking further about this. My email is rhaley@unbridledwealth.com. That's RHALEY @unbridledwealth.com. And you can also reach out at the Vision Possible website at visionpossible.net. But again, just a high level overview of these different dynamics, not giving specific investment advice to any specific person. Again, I'm not a certified financial planner. I'm not an investment advisor. I don't have a securities license, but I share this just as a high level concept to help you think through what you can do, what the different trade-offs are in that, and to share some of my personal experience that has both been things that I did very wrong as well as things that I did right. So I hope that's helpful for you guys. If you haven't already, I encourage you to check out our Vision Possible Protegé program. You can do that through our visionpossible.net website. You can also get a lot of other free resources and become part of this Protegé community that we have. So a lot of great things for you guys to look into, but I hope that's helpful for you guys. And I